So in today's video, we're going to talk a little bit about dollar cost averaging and pretty much how to effectively use it. So basically, for the most part, most of us, use support and resistance, and we're also trading according to the news. But for instance, like this pullback that happened here, and we were looking for that to bounce maybe off theoretically in that same area just because we know the price action kind of met up there quite a bit not too long ago. So we seen a good descent like this, and we pretty much got ourselves positioned maybe at 17.05 or $17. We'll just use an even number for this. And what happened was is basically traded against us, so it went down a little bit, and we said, well, we didn't buy low enough. This absolutely sucks. How are we going to take care of this now? And you can tell this did this within a month period, because if you're looking at basically the way my chart's set up, these lines, this all happened within a month. So we bought in at 17 right in the middle of the month. I mean, it traded almost down to like $15 exact, maybe 15.30 was the probably close enough to the low. So how are we going to fix this using dollar cost averaging? And this is going to explain dollar cost averaging fairly simple. So basically, I got everything set up here, and this is basically the formula which you're going to use to figure out cost average. So what you have to do is find out how much what you bought the shares at, how much did that cost, pretty much what it cost, and how many shares did you buy. So we're going to buy, in this example, just 100 more shares down at its low. So I'm going to pick probably the 15.30, and we're just going to go with that. And the cost of that, of course, is going to be about $1,530. And now what we're going to do is look for the cost of the trade. So by adding those up, we come up with about $32.50. And what we want to do now is divide that out by the number of shares we have. So we have about 200 shares. And then now, what do we get from that? That is going to bring us our cost average. So real quick, a correction I wanted to make to this. It was actually $32.30 for that. I think I said 50 there. But dividing that out by 200, we come up with a cost average of $16.50. So remember, our first position was at $17 even. So the $16.50 mark brings us to a cost average here, considering the fact that we buy down at the $15.30. So what it basically did is it brought us to the halfway point. So we weren't missing absolutely 100% of that movement. Now, if you doubled up on these, where you bought 200 shares at your second pop, of course it's going to be cheaper, but you're still going to be putting out money. This is basically what that would look like. So with doing this, we can tell we have more shares bought at the same price, but the cost of the trade is up because we bought 200 shares instead of just 100. And the overall cost of the trade is as well gone up to $47.60. We just divide that number out by the amount of shares that you have, and you come up with 1586. So let's see where 1586 is at. 1586 is about right there. So now you're capturing a lot more of that movement by doubling up when you went down. So now this kind of gives you a better idea of when you cost average down with how many shares you're buying, how really, I guess, low from the point you bought in at. Are you just trying to get it to the halfway point, 3/4, or close to the point at which you bought in at? I mean, we could probably even go up to like 300 shares, and it would bring us down maybe just a few pennies lower. So it just depends on how much you're really trying to rebound and how much do you really think it's going to come back up, I guess, for the most part. It is a probability thing, and typically nobody trades with a stop using this method until they get their final position in. And when they get their final position in, maybe that might be 2 positions, and then they have a stop put in after that second position to sell all those shares at a particular amount. Or maybe they might even go cost average down 3 times. I remember even in the past when I traded stock, long term, I'd try to cost average down on a long-term run, and basically doing that strategy. What you're doing is buying small shares to start off with, And then as it begins to get really low, you can afford to get the shares much cheaper so you can go in much heavier. But then it's just kind of turning out of how much is it really going to rebound. And I remember when I did it, I rebounded back some of my money, but not all of it. But I still reduced the loss that I could have taken by doing so. So it was still actually a pretty good strategy. And I'm kind of glad that I did it. But there is another way of trading, which is just basically cutting your loss. You put in a position, you have a stop, it gets you out, it just basically gets you out. That's pretty good. But I think at times, even stops can get people into trouble. So I'm a bit divided on it because a lot of people, when they trade with a stop, they trade too tight. And with this method, maybe you just falsely called a bottom and it didn't really hit. And you want to give a second chance to really kind of try it again. And with doing this, you can clearly see, we're testing another area of support just by doing that. So that's basically about it. And I hope that you find this video very useful in your trading and it just kind of helped you understand the cost average. Some brokerage companies, they have pretty much have that within their platform. When you buy and you buy again, they'll have kind of a dollar cost average. It'll calculate it for you, but if you didn't know what it was and you didn't know how it was calculated, this is basically what that is doing. So thank you for watching my video.